Good afternoon, everybody. My name's Mark Rowbotham, customs consultant with the BCC, but with particular chambers, Cumbria now, as well as further south, northwest Lancashire, etc. My job as a consultant is to let people know what the issues are concerning customs and even VAT. Now, we have upon us a rather momentous event coming up at the end of the month, assuming it happens, which is, of course, the withdrawal of the EU, from the UK rather, from the EU. It may be the other way round, in fact. But basically that the UK is leaving the European Union and therefore will be adopting its own national procedures for everything it does. Firstly, just to look at Brexit. What is it? It's the withdrawal of the United Kingdom from the European Union, from the whole governmental system, the single market, and effectively how our whole international and national operations are going to work as an independent nation. Now, this is a very far-reaching move, and it will result in a huge number of changes, particularly in the area of international trade, and even within that, the position concerning customs, VAT, and possibly other taxes such as excise and anything else to do with anti-dumping duties and even export controls. Now, the principle being we sever all our ties with the single market and therefore we will be on our own as an independent nation. We will be independent from everything in the European Union other than that which we choose to remain part of, such as maritime conventions, aviation conventions, and perhaps others such as the Common Transit Convention, which is to do with trailers crossing the European Union, traders as well maybe, because they're going to another country outside the EU. Now that in itself is an issue, but that is at the moment under negotiation and we wait to see what decisions are going to be made. Now the single market concept, such as it's existed, is the free movement of goods, services, capital and labour. Now that in itself has given rise to a frictionless system of trading where there were no customs controls whatsoever, and indeed taxation was taken care of on effectively a zero rating system, particularly for VAT and certain other taxes which might be involved regarding trade with very specific countries. Now, the single market concept also assumed that we would remain part of the single market itself, that we would maintain our full relations with Brussels and that therefore we would be part of the single market and the European Union system as a total bloc. Now, because of the exit, that will no longer apply. We will eventually be seeking to move on to a free trade concept, which is the free movement of goods, services and capital, but not labour, because we will have a completely independent national regime and therefore our borders will be subject to full controls when it comes to the entry and exit of people. But what it would allow us to do is have a free trade agreement with the EU subject to the conditions of origin status, effectively how the goods were made, and basically to what extent they would be allowed into the European Union on a completely duty-free basis. It would allow for the free movement of capital through the banking systems and even for services as well. But the condition would be that we retain our national borders and indeed would retain any control such as immigration and customs over those borders, so that movements between the UK and the EU, as opposed to the single market, would now be subject to customs controls in the form of import and export declarations. However, that concept has yet to be fully finalised, and it may be a while before a full free trade agreement is in fact negotiated with the European Union. On the other hand, we have a customs union concept that effectively says we have the same tariffs and commodity codes as the European Union and therefore would charge the same amounts of duty and the appropriate duty rates, but that we would still be an independent nation with full customs controls. The only difference being that because of the customs union, we would therefore be subject to free trade agreements that are negotiated between the EU and other countries, and we wouldn't have the freedom to negotiate our own free trade agreements as a result. So there are pros and cons in whichever way you look at it. It may be that part of the UK will retain a customs union, i.e. Ulster, but that depends very much upon the negotiations with the EU and in particular with the Republic of Ireland, because of the need to have some form of cross-border arrangement, however simplified it may be. But it does still give room for a temporary measure if that is what the UK government decides to implement. However, if we come out without a deal, that means we are subject to the full rules of the World Trade Organization. This means we will have to have our own customs frontiers, our own national tariffs, our own import and export customs declarations. They will be subject for imports to import duties and even the imposition of import VAT. We would also have our own national quotas on products such as steel, ceramics, textiles, anything where there may well be limitations even now in terms of the imports that are allowed by the European Union from nations very much distant, perhaps the Far East, Africa, places where a lot of materials coming up to now on largely an uncontrolled basis. It depends on the economy and it depends what sort of restrictions might be imposed depending upon the economic circumstances. Origin requirements will of course be an issue because we will no longer be part of the single market bloc. This means that there will be very distinct origin rules concerning whether products that are manufactured in the UK will be admitted to the EU on a duty-free or duty-reduced basis. Certainly, if most of the material comes from the UK itself, that would not be an issue. But if we continue with our massive policy of importing materials from the likes of India, Taiwan, China and elsewhere, then there is no guarantee that the products that we manufacture would in fact originate because of the rules of origin, and as a result would be subject to full import duties when imported into the European Union. So these are all areas which must be taken into account because they will ultimately affect the UK economy and, for that matter, its trading relationship with the European Union. With tariffs, they are organised essentially by the World Trade Organization. Although duty rates are still determined by the countries themselves, the actual tariffs are dealt with from the WTO. As it stands, the tariffs allow for a full 8-digit system, although for international movements, HMRC recommends that the trader only put the first 6 digits of the tariff on the invoice. It is known as the Harmonised Code System, the HS code, because these codes are in fact operative worldwide. It is the last 2 digits of the tariff which differ from country to country. But these are technical issues that I wouldn't expect everybody to look at immediately, although advice is available from the Chamber about these issues. Certainly the issue of how duty is calculated due to what we call the ad valorem value, which is based on the value itself, and then the resulting import duty rate dependent upon the tariff. These are issues that apply anyway and are a global issue, not strictly simply the EU or the UK. And then preferential issues concerning origin and whether there would be a free trade agreement negotiated with the EU at some stage in the near future. One would like to think so, but then the subject of politics creeps in and such negotiations can take a long time to be fully ratified and agreed. Now, on some products there aren't any duties at all. Computers are a classic example, as are basic raw materials, steel or iron, timber, other raw materials, because they cannot be used in their existing form and therefore have to be processed. So in the tariff there are many products which have no duty rate at all because of their commercial status. We also have other preferential arrangements through the system called GSP, Generalized System of Preferences, which is used globally and basically favours trade with the developing nations because obviously the need is to help their economies develop as much as possible. So there are particular preferences for that sort of trading, although they're not reciprocal, as with a free trade agreement, they tend to be one-sided, so that we would import duty-free or duty-reduced from a particular country, but it would maintain its higher tariffs against us. There are other issues such as anti-dumping duties, countervailing duties to adjust the price of the imported material to a local market price, as opposed to simply accepting the price that was issued by our supplier. With the economic implications, it comes down to effectively the national economy, the needs of the economy, very definitely the protection of our economic system, and to what extent we need to have import duties in place or even other duties so as to partly bolster national revenue for the government, but equally to perhaps deter a degree of international trade if it was deemed as being a threat to our national economic structure. For instance, very cheap imports or massive quantities of goods being imported that possibly could be made locally, but certainly could in fact damage our economy on a long-term basis. It also means an independent taxation system, the imposition, of course, of national frontiers, independent free trade deals, of which some have already been negotiated, and then also an independent banking system that is not linked with places such as Frankfurt or Paris or elsewhere in the European Union. For customs, this is the main issue though. It is the whole issue of the imposition of customs controls at the border, some of which are presently dealt with by UK Border Force, but the rest does go through HMRC. And it will mean full import and export controls and declarations, the need for trader compliance, which is a present issue anyway and is very much ongoing because of HMRC's insistence that there is a need for regulation of traders, how they do the business, but equally how they record information concerning imports and exports, and for that matter the documentation and procedures that they have in place to ensure that they are compliant with customs regulations. The issues of electronics figure as well because of an increasing reliance on electronic management. In fact, this is part of the global customs initiative where every trader is required to use electronic procedures for its imports, its exports, as well as its accounting systems and its record keeping. So that is rapidly becoming a fully electronic regime where conventional paperwork will simply not exist, even down to things like bills of lading for sea transport, certificates of origin, anything that is ancillary to customs practice but still is part of the overall trading process. And then there is risk management, and this is an area which HMRC are increasingly publicising, the need for the trader to look at their own risks, because HMRC can conduct its own analyses of trader practices and performances and can therefore impose risk levels that the trader might not have even thought of, particularly to do with high risk, and therefore whether a trader is particularly suited for customs approvals or whether it can be allowed to take on board particular facilities based on its understanding of customs procedures, which then leads into the competence of the staff as well as the trader in terms of imports and exports, and therefore to what extent is the trader in control of what it does, both for importing and for exporting. Now, for the export procedures, a completely new system is going to emerge. Firstly, being outside the European Union means that we will not be able to use the internal security mechanisms that up to now we have. We will be subject to cargo pre-clearance examinations, which means that all cargoes will have to be pre-cleared through the Brussels computer before even an electronic declaration is submitted. It is because of the international security systems led partly by the American CT-PAT system, but very definitely in the wake of the 9/11 catastrophe, where it was realised that international control systems were not as secure as they should have been, and as a result of which new procedures were implemented that would mean the cargo had to be pre-cleared before it got anywhere near the country of destination, even before it was loaded aboard vessel or aircraft. This system is used very much by Brussels as well, and it will apply to exports from the UK because they will have to be pre-cleared going into the European Union. On top of that, there will be simplified declaration procedures, which means that rather than a full declaration be raised by the agent, it will be a very abbreviated declaration that will then be cleared by the European Customs Computer System to allow access into the EU, and then followed up by a spreadsheet report the following month, which effectively would contain details of all the transactions for export carried out by that particular trader using their VAT number pertaining to intra-European trade. So this means that there will be a completely new regime for traffic with Europe. Eventually it may be rolled out for the whole of the globe, but that is something to happen in the future. At the moment it is restricted to European traffic, but it still means that the trader has to be compliant in what they're actually doing, because inevitably they will have to ensure that all the cargoes that they plan to export are properly cleared through the Brussels computer before they can even be loaded aboard vessel. We also have transitional simplified procedures for imports, but I will come on to that in a minute. The other area of concern is the use of spreadsheets, because again HMRC insist that every exporter has a documented system of procedures in place for exports and imports, and that it must have a very comprehensive set of spreadsheet data records concerning all of its import transactions and equally all of its export transactions, as well as the fact that export declarations are going to be issued, and that means that the trader must keep copies of these declarations for the relevant periods required for audit purposes by HMRC. Normally it's 5 years, but it is recommended that in some cases the records are kept for slightly longer, especially on sensitive and control goods. Now for import, there is a very definite change to what we call transitional simplified procedures. Now these mean that when goods come into the country, they firstly have to have an initial pre-declaration made. It's called a simplified frontier declaration, although Revenue and Customs has suggested that this would only be absolutely necessary for control goods and the rest would be more of a voluntary or certainly non-mandatory system. I have no doubt they'll change their minds again and say, well, yes, we need a simplified declaration just to get the goods through the port, because obviously there is a need for the port operators to make sure that trailers do not leave the port unless they have been already correctly linked with the customs computer. Anyway, the new system called Transitional Simplified Procedures is designed to take into account the whole of the import movement using the SFD at the point of the goods being dispatched from Europe. Once they've arrived in this country, that information is then put in the port computer system and it will release the goods automatically pending the delivery to the importing trader. When the trader has received the goods in their premises, around about 24 hours after they've been initially cleared at the port, then they must put in a supplementary declaration basically stating they've received the goods. And then at a later stage, agreed certainly by HMRC at some stage, a full declaration will then have to be made in order to clear those goods into free circulation. Again, it requires import transaction spreadsheets because in the meantime, given the possibility of congestion and the fact that the system may not work properly from day one, there will be the need for import transaction spreadsheets, as with exports, for the trader to show to customs, should they ask, these are the transactions we carried out and these are the implications of import and export in the form of duty and VAT that may be payable. Now with TSP, the arrangement being, as I've stated, the goods arrive in the UK, cleared through the port, on the way to the trader, a second declaration, a supplementary declaration that is, goes to the HM Revenue and Customs at the time of arrival of the goods, and then at an agreed later date, the import declaration itself will be performed and submitted to HMRC accordingly. So that means that the full entry is carried out more or less at the trader's premises themselves. Now, the requirements for this, firstly an EORI, the Economic Operator Registered Identification. A comprehensive customs guarantee to cover the duty and VAT while the consignment is in transit, because that is an essential, that any cargo which is in transit between the port or the airport and the trader's premises will be subject to VAT and duty as far as an actual debt is concerned, because it will not have been paid outright at the port of clearance. Now, under those circumstances, what is required is a financial guarantee to cover each individual shipment, although using a facility we called SIVA, Simplified Import VAT Accounting, it is possible to remove the VAT from that requirement for the coverage of the debt, and therefore that the only guarantee required is for import duty, because in reality the VAT is being reclaimed. So in reality there are different procedures required, although they can be applied for at the same time, as long as the trader is equipped to handle the imports from the EU of whatever the consignments are, and then to ensure that they are correctly cleared at the time appropriate as dictated by HMRC. Alongside that, the import trader is being required by HMRC to have a duty deferment account in place, because the sheer volume of imports that will be coming through from Europe at any one time, it would be seen as impractical for an importer to pay import duty and VAT every time a consignment comes in, especially if consignments are daily. So what HMRC are now doing is requiring these importers to have a duty deferment account, which effectively means that you defer the payment of the duty and the VAT until the following month, when an overall declaration is submitted to customs based on all the transactions that have occurred for that trader during the month, and then the duty and VAT on all of those import transactions is removed from the trader's account by direct debit on a fixed day of the month following all the transactions. However, that said, it is still a necessity for the trader to monitor deferment account statements and to make sure that they have all the procedures in place to ensure compliance, whether from a recording point of view of information through to the production of the actual entries, which are of course vital to the process, and followed up then by the customs spreadsheet system called MSS, which then means that as well as customs producing a line-by-line spreadsheet of all the import and all the export transactions, albeit on different files, one for imports, one for exports, that the trader then has access to this to check against their own accounts to make sure that import duty was indeed paid correctly and that they have copies of the relevant documentation accordingly. Import VAT up to now has been paid outright or has been deferred until an agreed future date when it was withdrawn from the trader's account by direct debit. This is now going to change. HMRC have already stated they're going to revert to a system used many years ago, which I in fact did use myself when I was in customs, called import VAT accounting. Now this means the import VAT postponement in actual fact, although it is an accounting measure, it is actual postponement. What happens is that although the import VAT is still calculated on an import entry, it isn't paid at the time. It's actually postponed until the VAT return is then submitted, and all the import VAT resulting from the import transactions for that month is included in the VAT return, and then the reverse charge mechanism applies so that the trader charges themselves the VAT as if they paid it, and then reclaims it back through the VAT return system. It results in a zero condition, which means that the trader does not physically own a liability in import VAT. It has already been taken care of in the import VAT postponement system. With origin and preferences, we have certain agreements already ratified, namely with Switzerland, Israel, South Korea and Chile, which will mean that from the moment we leave the European Union, we will be able to trade with them on a free trade basis. However, there are a lot of other countries we need to negotiate with, and that will take inevitably a considerable amount of time, which means that in the meantime all the goods travelling between these countries will be subject to import duty and VAT, whichever direction they're going in. Now, the purpose of the origin system is to ensure that if, let's say, there's a free trade agreement, that the goods that actually originate in the country of export can then cross into the country of import, subject to the free trade agreement on a duty-free basis. But it is very conditional, and that means that the origin of the materials must be established, in this case as being UK, and for that matter that the correct criteria according to the HMRC requirements are themselves obeyed, particularly to do with the substantial transformation of the goods from one tariff chapter to another, and even then within the system to what extent are imported materials used in the process, and therefore how much of space do these materials occupy when it comes to the calculation of overall status, and therefore the differential between imported materials which do not count for origin and then exported materials which do. And again, HMRC will be placing more vigilance on this area because of potential fraud by certain traders who claim the goods were made in the UK. In fact, they weren't. They were imported from elsewhere and therefore would normally be subject to import duty at the point of import into the country of destination. Again, it relies on trader self-assessment and due diligence. So again, it's an area that HMRC are pulling up fairly rapidly. With VAT, we'll be separated from the EU. We will have our own VAT regimes, and therefore we need to include that in the procedures that we deal with, because for every trader there is a need to look at the VAT regime as much as there is duty to determine whether the right amounts were paid out in the first place and then subsequently reclaimed on the following VAT return. The present system allows for vetting as well, but it is a specific job and in general should only be carried out by approved staff that are dealing with the basic procedures, because again, HMRC needs to be sure that there are suitably experienced or qualified staff in the company concerned, because of the fact that that company is using customs procedures. Therefore, there has to be a need for due diligence and vigilance when it comes to making sure that entries are correct, and so too is the information that leads to the production of a declaration, and for that matter what is contained in a commercial invoice. The other side of that, obviously, with import VAT postponement, it will actually give very distinct advantages to the trader because of cash flow issues, in that you don't spend the import VAT, you simply wait until it goes on the VAT return and then you reclaim it against the overall VAT figures based on the fact that it is a purchase tax, but in this case it's an international one. Other than that, for VAT, there may be a need for the trader to apply for a European VAT number, because they're dealing with customers in Europe that are not customs registered. Although they have a VAT number, they're not registered as importers. And then the question is, to what extent should the UK trader then become approved for VAT and hence import duty on the continent, depending upon where the majority of these traders sit. It is not an absolute foregone conclusion that this will be necessary, but it's still worthwhile investigating in case the European customer has said that they require the EU supplier to be VAT registered in that EU country. In any case, the import VAT number and the customs registered part of it is then used for the reclaim of import VAT, should the UK exporter be required to undergo their own clearances on the continent using their own status, which means they would have to have an EU VAT number for the purposes of clearance through the EU customs computer. The other requirements, the EORI numbers have stated, import and export transaction sheets, which are an absolute necessity in terms of record keeping, the HMRC MSS transaction system that I've already mentioned, documented import and export procedures. Now, this is already an HMRC requirement where the company must have in place documented SOPs for imports and exports to make sure that there is a continuity of staff working on these areas in case one should go on holiday or retire, and that is why in any case, for customs purposes and therefore auditing, there needs to be a set of procedures in place to make sure that the company is aware of its rights and responsibilities concerning importing and exporting, as well as dealing with the day-to-day procedures of how to bring goods into the country or even how to export them. And then from that, regular management checks of imports and exports to make sure, in the case of an independent auditor, that company is carrying out all its procedures correctly, because it cannot be done by somebody within because of familiarity. Although there is a need for an internal management check, it must be supported by an external check, which obviously takes some time and costs some money. However, it's a necessity to make sure that the company is on the straight and narrow. Even without Brexit, these measures are already in place. They're part of the global customs initiative, and therefore are seen as something which already has got to be applied regardless of the Brexit scenario. And to this extent, it is the responsibility of the import and export trader to look at the systems and determine whether they are indeed compliant, or whether they need to rectify their present structures, and indeed perhaps call in a consultant who will be able to identify specific issues and therefore ensure that they have the procedures in place to cover them if necessary, with reference to particular figure work should it be perhaps declared erroneous, or again because simply nobody has done any checks into physical duty or VAT liability, which is something that does have to be done. And then HMR approvals, which are happening anyway, IPR, inward processing relief, OPR, outward processing relief, customs bonded or simply customs warehousing. These are all areas that can be approved. However, HMRC require the trader to be absolutely compliant in each area if they are to go down that approval route. And then, of course, on top of that, trader awareness and competence in customs procedures, which again is a requirement now by HMRC for all importers and exporters, where they must have a member of staff fully trained in import and export customs procedures accordingly, so that they can act as the contact between HMRC and the company itself, even with the provision of a director's name on the approval sheets as well. A lot of this has come from the Union Customs Code, which was the successor to the Community Customs Code of 1992, and the Union Customs Code was implemented literally a month before our referendum. It was implemented in May 2016, and it certainly spells out the areas I've already mentioned, because it looks very much at trader compliance and the trader's ability to carry out certain functions without the need to be monitored and vetted by HMRC on a regular basis. Therefore, it does make provision for particular traders to be fully authorised to carry out these procedures under what we call AEO, but also to make sure that in general traders are compliant with the regulations, whatever they may be. And then, is it a purely European issue? No, it comes originally from the revised Kyoto Convention and the Safe Framework of Standards, both of which are global initiatives dating back to 2005, but later revised. It also has a lot to do with the basic principles of trade, to do with electronic declarations, trader self-assessment, risk compliance, because there is always a risk, but it depends upon how high it is at the time, and compliance, because all these areas are quoted in the Safe Framework of Standards and need to be addressed because of the international influences of all this, and making sure that the trader themselves is rendered as compliant as possible. That is all I want to say. It is a very complex issue and it cannot be dealt with overnight. However, as I have to say, please do contact the Chamber. We have a Brexit line. It's part of the Chamber's number, which is 0845 226 0040. I'll repeat that, 0845 226 0040, and Chamber staff will be willing to help you, including myself. Although I live at a distance, I often come up to Cumbria, so if you do have any issues, not just for Brexit, but for customs and VAT in general, we will be willing to help you. So thank you very much. I hope you've gained something out of the webinar. We will be sending the slides out, so you'll have a chance to see the details, but as I said, please do contact us if you have any issues at all, and we will be willing to help you, if only to help you out of issues with customers where there may be problems. This is what we're here for. Thank you very much.